Hey folks, this is Mike Zletnik, Big Mike, and here are my comments after watching Jay Powell press conference this afternoon, recording this on Wednesday, January 29th, 2025, after the Fed announced the policy to keep the rates unchanged. So let me recap some key points. First of all, the Fed continued to outline that the current policy is stable and well calibrated. They kept interest rates, the Fed funds rate target at 4.25% to 4.5%. They obviously stated that they have dual mandate, labor stability, and inflation under control. They call it full employment and stable pricing. And they outlined that the risks are roughly balanced between the two mandates. Jay Powell commented that the GDP is at a healthy level, above 2% level, and they're not in a hurry to cut rates. They have taken a wait and see stance after executing 3 cuts last year, September cut of 50 basis points and 2 more cuts in November and December. They also pointed out that they look at the 12 months data, removing seasonal volatility in data. But Jay Powell also acknowledged that some of the inflation data has been coming in cooler than expected, especially one of the really important factors, they call it owner's equivalent of rent, has been coming down gradually lower, and they expect inflation to continue to cool. Nonetheless, they're still taking wait and see stance. And the reason for this is because it's new administration. One of the really important elements to their decision is they want to see the new administration policies and, most importantly, impact of these policies on trade, immigration, fiscal policy, and regulatory policy, and what those parts of the new administration strategy and executive orders, legislative agenda are going to do in relation to unemployment and in relation to price stability. And they continue to model, but Jay Powell outlined that there's a broad range of potential outcomes, and all the modeling is not to take action, just to prepare for possibilities. They do take action after they see the data. Very, very important element. So further comments where rates are up, independent of the Fed action on the Treasury's longer end of the yield curve. So U.S. Treasuries, for example, 10-year Treasury, 30-year Treasury, 5-year Treasury yields are up substantially, even though Fed has reduced the Fed rate through the last cuts, the last 3 cuts. So the Fed cut Fed funds rate by 100 basis points last year. Nonetheless, bond yields have been rising, and they've risen almost by the same amount. And folks have asked if that is attributed for a high inflation expectation. Jay Powell commented that he doesn't believe that the increase in yields on longer end of the yield curve, longer maturity bonds, is attributed to the high expectation of inflation. He believes it is simply driven by the term premium, which essentially states that the longer maturity bonds should be compensated with higher yield versus shorter maturity bonds. That was his comment. It was a really important comment. Again, not inflation expectation, but term premium. Next question that came to Jay Powell was about Trump comments and demand to lower interest rates. And Jay Powell bounced most of his questions, citing the fact that Fed is independent and the politicians and their statements have no impact on Fed decisions. And specifically, he was asked if he spoke with the president. He said he had no contact with the president. That's simple. Next, one of the important questions came up was the quantitative tightening, QT, runoff. When do they see it stopping? Are they likely going to continue? So what is a QT runoff? Is simply the Fed is selling bonds on its balance sheet. They're basically not increasing the size of the balance sheet, but trying to shrink. And Jay Powell commented that the reserves in the system are abundant, and therefore they don't see the need to stop the current runoff. So they're maintaining their path to reduce Fed balance sheet for now. AI impact. Wait and see. Same policy. It's a great new technology. The impact of AI is unknown. He was given the example of the volatility, especially in the recent days, related to the volatility of the stock market, Nvidia stock, and other related issues. And essentially, they don't interfere unless it creates stability problems for the financial system. So there was a comment about asset prices. And he made it very, very clear, very important comment, that he believes that the asset prices are at the elevated level, but by many metrics, which is a very important comment. They're acknowledging that the asset prices are high. However, he doesn't yet see that being a problem to the financial stability, which is the concern for Federal Reserve Bank. He commented that the households are resilient, although he did acknowledge that the lower income households are struggling simply with the higher prices, not high inflation. So that acknowledges the fact that we saw high inflation in the last few years, which elevated the prices. Inflation has cooled, and inflation really represents the growth of prices. But the prices themselves are at a much higher level than in the past because of the past inflation. So he acknowledged that that discrepancy between high income and low income consumers. There was a question about March cuts. So his comment on the March cuts was they are not in a hurry and still maintain wait and see policy. There was a question about 2% long-term inflation target. Is it still in play? Are they planning to change the target to a different number? He said absolutely not. They do 5-year reviews, and it is not on that review. They're not planning to change 2% long-term inflation target. There was a comment about crypto. What is their view on crypto? And he made it very, very simple, that the Fed's mission is really all about banks. And their impact on the banks is to make sure that the banks are safe, and the crypto trading or crypto-related business should not jeopardize banks. Today, he believes most of the banks are well capitalized, but what they do monitor, what impacts the Fed point of view, is effectively safety of the banking system. That's about it. Once again, the long conclusion, or the short conclusion of a long conversation, is no change, no news. Maybe a good news or bad news, but no news is a news. Well, we are dealing with no rate policy change, wait and see related to the new administration, and they will be very data driven, and they may change their stance. He made it very clear. If they see further weakness in the labor market or they see changes in inflation, they'll act accordingly. In the meanwhile, it's wait and see. There were a couple of other interesting questions related to the immigration, changes in the border, fewer migrants coming in, whether it's impacting certain sectors of the economy. And he did say that there was some anecdotal evidence that some construction projects are not able to obtain the labor that they need as a result of potentially changes in immigration policy. However, he doesn't see that in the data yet. And until any of these changes propagate the data, there's nothing that they plan to act upon. He did acknowledge that the hiring have come down substantially, and that's compensating for potentially reduction in the migrants, etc. So overall, wait and see. Overall, stable environment for the U.S. economy, and they'll revisit the issue in future meetings. That's about it. Appreciate your time and attention. Until the next time, take care.